Well, it is common knowledge that no amount of technological advancement can ever bring us close to being able to predict the future accurately. In the world of investments, too, there is no way anyone can predict with a degree of credible preciseness as to how certain assets will perform within a particular time horizon. Yes, uncertainty will always be inevitable, but there are ample ways through which we can prepare ourselves and plan responses to uncertainty in life. In the world of finance, asset allocation is the ritual that can see you through periods of turmoil. Now consider this. A farmer cultivating a group of crops with diverse requirements in terms of climate and soil conditions is more likely to have a steadier produce all year round than a farmer who cultivates only a particular kind of crop with a specific set of soil and weather requirements. Asset allocation works in similar ways and facilitates the division of your money across varied asset classes so that the capital is safeguarded as much as possible and growth potential can be maximized irrespective of market conditions. Now, the start of the financial year can be a suitable time to assess your financial health as well as review the performance of your investments. Basing your investment strategy by trying to predict the next winning asset class can seldom yield positive results. Rather, investing in different asset classes is sacrosanct for maintaining financial stability in the long haul as each asset class responds differently to macroeconomic developments and it tends to move cyclically. Hence, financial experts have always maintained that keeping a diversified portfolio with investments spread across varying asset classes is crucial for ensuring that your portfolio's risk does not reach tolerable levels because of the concentration of one or more assets. Now, decoding the right balance between risk and reward can be a game changer in your investment journey, and maintaining that balance is a constant process. Both these variables undergo changes at different stages of life and are closely interlinked with circumstances, your income, and your goals. However, finding the right diversification formula can seem like a complicated puzzle. So let's find out how we can solve this puzzle together. I'm your host Gautam Srinivasan, and today we have a special presentation from Mint where we will delve into the gamut of asset allocation. And joining me in this conversation are Mayukh Datta, Head Product Strategy and Communication at Mirae Asset Investment Managers India Private Limited, Manju Mastaskar, Managing Director at Armstrong Capital and Financial Services Private Limited from Bengaluru, and Bhuvanesh R, Business Analyst at Zerodha. Thank you everyone for joining us on this talk. It's great to have you come in and provide your expertise on the topic. So Manju, we'll start with you. Considering that in the last 2 years, uncertainty has sort of become the norm. So how would you describe the importance of asset allocation in, if we could call it, the post-pandemic world?
Okay, so asset allocation is important and it has to be maintained at all point of time. It's not the pre-COVID or post-COVID times. It has to be a kind of balance which has to be there in the portfolio at all points of time. It's when there is a drastic fall in the market, that's when the investor starts panicking, and he starts moving into something safe, basically trying to avoid the volatility. And that's his mindset, because he wants to preserve whatever is left for him on the table. In fact, that's a good time to invest into equities. But at that point of time, the investor would not have the liquidity nor the mindset of investing into equities. So he tends to move away from there, and he also has a negative mindset because he's seen a drastic fall. So when we see the markets rise, we see them rise over a period of time slowly, and when we see them fall, they fall all of a sudden in 2 and 3 days, and it's wiped off all the gains of 3-4 months. So that's when they panic and they really want to come out of it. So asset allocation is important. It's important to maintain the balance so that you have got something on the side into an asset class which has a negative correlation with equities, so that that money is available for you to average out, for you to get into different kind of sectors, or get into stocks which can kind of average out your portfolio and give you better returns. So asset allocation at all points of time is very important, and it has to be maintained in the portfolio.
Absolutely. Balance your assets as all things should be. And as you said, nobody can predict the markets. 1 month before, nobody knew the geopolitical events which were going to happen, which would swing markets either way. And we see markets swing like never before. And that's why it makes sense to balance your assets. Point taken. Bhuvnesh, coming to you, Indians, especially the older generation, they've shown a penchant for certain asset classes while, say, harboring distrust for others. So, in this context, what are some notions and biases that investors need to be wary of when deciding their asset allocation strategies?
This is one question where I wish I had a non-cliched answer, but unfortunately, all the vote cliches are true. So here, I think one thing that investors have to kind of keep in their mind is your formative experience will have a dramatic impact on what you think about the markets. So just to give you one simple example, most Indians invest their money in real estate and gold. That's because most of the other people before them were doing the same thing, and those experiences kind of shape people's perspectives and thoughts about how to take risks, where to put their money, how to save, so on and so forth. Interestingly, there was this one study which was done a while ago. So in 1929, there was this Great Depression in the US where the markets fell about 90%, I think, from their peaks. So that event kind of scarred an entire generation of investors, so much so that in the next 30 to 40 years, so the number of people who participated in the US market fell to like a drastic low. So all these people, they stopped taking the risk, not just in the markets but also in their personal lives, in their careers. So the notion of safety became so pervasive in this generation that it took the next 70, 80 years for that retail participation in the US markets to pick up. And you can see this in the same this thing also in Indian markets also. So we just have about 2.7 crore unique mutual fund investors, which is absolutely nothing in spite of there being a long enough track record for our markets. And the second thing is it's just pure availability bias. Let's say, for example, if I were to invest, the first thing I'll do is ask around my family, friends, and if they're all putting their money in fixed deposits, I'm going to do the same thing because we are evolutionarily hardwired not to do anything, not to seek out conflicting opinions. It creates a cognitive dissonance in your head. So that means you need to be aware that all these things can kind of shape your perspective. And if the moment you have the first 1,000 rupees that you can go and invest, the first thing you need to do is be comfortable with being uncomfortable and start googling that there might be something apart from whatever your mom or dad told, and that piece of plot they promised you that is the best investment in your life. So these two things by far kind of shape your perspective about markets.
Absolutely. And I'm interested to see how millennials, who I would say have been handling volatility since 2008, right? We had the great financial crisis, and
Right.
ever since then, markets have had something or the other to factor in terms of extreme volatility. I wonder how it kind of shapes their thinking around staying the course despite seeing all these dips. We'll explore that later in the conversation. Meanwhile, Mayukh, according to you, what are the factors one needs to weigh in when drafting an asset allocation strategy? We've got viewpoints coming in from other experts, bringing it all together. The factors that one needs to weigh in when drafting an asset allocation strategy from you.
Okay. So hi Gautam. So to your question, my response would be a good place to start would be to first realize where is each individual at this point of time in their life, what are their needs, and how much time they have to be able to reach a certain destination. So to put it in other words, if an investor has x amount of money and say in a n number of years, it could be 5, 10, 15, 20, 30, whatever it could be, what is that where they finally want to reach to, and what is that amount which they should have, and then you can work backwards that this is what you need. And once you have fixed your goal post, as it is said in a famous book, then you do not move your goal post, and then your asset allocation is your tool, is your method, is your allocation which will take you to there. Then it gets slightly little bit more technical, is that to see that what is the run rate you need to be there, and how much time is it required. That's when you decide your asset allocation, and that's when those individual or separate asset classes come into play. uh, Another point which I would say is also important when it comes to asset allocation is generally people tend to think not about their physical assets as a part of their asset allocation discussion. So when you have it will always be a discussion about where is the investable surplus anybody has, which is basically another word for your savings, and where it should be going into. People tend to look at asset allocation being only about the liquidity which they have in hand, or what they would like to invest, whether it is yearly, annually, or whatever. They would not probably look at an FD or their house or their home loan also as a part when they are doing their asset allocation, because that is also a cash flow issue which will then limit that much on that. So when asset allocation comes in, they also need to look at it, what assets they already have, what is their run rate in terms of their payout also, and also what they can earn. So for example, if my home loan is, let's say, at 8%, just for example, so it's an outflow towards an asset which I already have. And I also have a bank FD which is at 5%, which is on which I'm earning an X amount which I'm saving for a rainy day. So when you do asset allocation, technically asset allocation just gets into a very back of the paper discussion that, oh, I earn 100 rupees or I can save 20, so where do I put a 20? Can I do an SIP? Because from a mutual fund syntax, that's all which you're thinking about. But from an individual's point of view, life is much more complicated than that. And unless somebody writes it down, he or herself, you cannot go to somebody with asking for help, because unless you have not put it down everything on paper. And all of this I will complete is with the thought process to put the overall cloud on this is a your rate of inflation which you cannot control, and taxation which is god given. So then, beyond whatever you are expecting a run rate, please put in a inflation number and a taxation also to that, because net of these two is what is left in your and my hands. And that should then be enough to take me to my goals, which I talked about 3 minutes back, that this is the goal it should come to. So these are very important factors, which I would say asset allocation is a heavy word. We have complicated it. It's just a write down of your net worth on a piece of paper, what's your outflows and inflows, and you can then take it from there.
Stand when it comes to money, and some important points there for anyone to consider when looking at it from an asset allocation perspective, which Mayukh has shared. Of course, the having that goal itself is one of the primary requirements. I think a lot of the time we forget that you need to have solid goals for which you build your finances towards, and then let's see how the investments take care of your goals. Moving ahead in the conversation, Bhuvnesh, investors may understand diversification, but they feel helpless on how to execute asset allocation and therefore diversify. And then comes the big question: who will help and how to do asset allocation? So, coming from a digital platform, what are the trends that you see when it comes to asset allocation in a digital world? Picking up from where we spoke last, where I wondered, since millennials have been sort of used to volatility, and we are in the midst of a sort of a digital interface revolution for everything in life, especially in finance, what are the defining trends that you are seeing?
No, I'd actually start there. The defining trend itself is that there are so many youngsters who are investing, and these people don't tend to have a lot of savings on their hands. So because they'd be getting their first paychecks, or they don't save some money from an odd hobby or some passive income they might be generating, so on and so forth. So at this point, even if you look back to the older generations, people typically didn't have this asset allocation mindset, that Mike also mentioned. Because one, it's a heavy word. Two, I think these people tend to uh, think of it as a starting point rather than think holistically. And there's nothing wrong with that, because these people typically just look around, ask their friends, or maybe look online and see that you're supposed to start an SIP in a fund, or some mutual fund, etc. And so on. They start there. And if you get into granularly, at least in the online platforms, broadly I'm speaking, the defining trends have been that some of these passive funds and ETFs, etc., have been quite popular. So that means this generation kind of thinks a little differently compared to the other generation. In fact, on our own platforms at Zerodha itself, some of these low cost funds have been quite popular, because especially ETFs, because one, they're relatively easier to understand, and there isn't a lot of mental burden required to kind of figure out what you're getting. Because in a sense that if you're buying Nifty ETF, you're getting Nifty, and you don't have to worry about some fund manager. You don't have to worry about some philosophy, so on and so forth. Not that there is something wrong with that, but if you are making your first investment, I mean, nobody in the right minds would have the mindset to sit and understand these things. So those things have been quite popular, and also these international funds have been quite popular. And as for both these trends, the fact that returns have been good is, of course, it goes without saying that that is one of the reason, and that will never change. That is pure human behavior. But it's a good thing that people are also thinking outside, because these people grew up using brands like Facebook, Google, so on and so forth, and uh, the most popular international funds tend to be US funds because these are the brands that this generation tends to identify. And that is a really, really good thing, because at the end of the day, you can say that Indian markets and US markets might be correlated, but at some point they have that additional layer of diversification is always good. And also, more specifically, some of these youngsters, at least in our experience, so this debt is a heavy category with 16 categories. I mean, I can't figure it out. I get scared. So what typically most of these people do is they put it in a liquid fund and ultra short fund, which is a good place to start, because they have that ballast in their portfolio, so that they're not at least 100% exposed. Or some people even go to the equities, which is nothing. So I wouldn't say these people think of these things from a holistic asset allocation perspective, but if you flip it, this is pretty much what they're doing, and it is a good thing, because you ideally want them to make all these mistakes in the first year of the journey, so that it's less costlier. Because even if they blow up their account with some wrong thematic mutual fund, the worst thing they can do is they'll lose a couple of thousand, which isn't a high price to pay, and they'll be better off for it. So that is how we are thinking about it, and those are the trends that we can see.
And we have to give credit to the funds universe as well, considering that the variety of options which are available to investors, they've expanded so exponentially that the right kind of asset allocation strategies can come about as well, where it brings out that balances as say an investor deems fit. On that note, Manju, what are the different kinds of asset allocation that our investors who are watching should know, and if you could list out the pros and cons of each kind.
Yeah. So, as I mentioned, asset allocation has to be preferably into those asset classes which have a negative relation with the equity. So, the first and foremost is the debt, because as an asset allocation, we also prefer debt investments, and especially in the low duration short-term funds and ultra short-term kind of funds, and not the credit ones, because credit ones will have their own exit loads and will really not will really sometimes also be negative when there's a crash in the markets. So advantages of these asset allocation is when there's a crash in the market, and when they want to average out, and at that point of time some funds have to be on the side, so that it gets invested. The disadvantage is that since the last 18 to 20 months, the debt funds have been giving significantly very low returns. So when our investor looks at that debt fund, says, hey, what my equity is giving me about 50% returns, and this debt fund is giving me 2-3% kind of returns. It's a waste of time. So let me put all that into equity. But what happens is that once there is a crash in the market, that debt fund is available, and you invest into equities, then that portion of that investment can give you about 10% returns in 3 or 4 days. So it kind of averages out your entire portfolio's returns. So you need to have something on the other side which doesn't have a positive correlation with equity. Second asset class would be gold. That's a good parking place whenever we have global uncertainties. That's where gold as an asset class does well. It's a tactical call. It's for some time you invest into that, and then you exit when things are clear. You can't be invested in gold for a very long period of time, because even if you take a 7 year or 10 year kind of horizon, you may not really make great returns out of that. And in fact, equities or even cumulative debt funds could give you much better returns. Then the third option, as what was mentioned earlier, which has emerged, is the international funds, international thematic funds, and also a couple of funds on the real estate side have come up. These offer not a very negative correlation, but they do help in diversification. If there's a global issue, then yes, everything would fall. But if there are issues specific to India, these happen to be a good hedge. And when we see FI selling, we see rupee depreciation, all these funds will appreciate as their NAVs are quoted in USD. Then few sector funds within India, like pharma, like FMCG, they had done well even in the past in the 2020 fall. So some kind of diversification into these are the ones which will make a good asset allocation. And finally, even from a holistic perspective, we suggest having some fixed deposits, some recurring deposits, some post office kind of deposits, something like that, so that the client doesn't feel that everything is with mutual fund, because they don't look at it as mutual fund from a debt mutual fund, equity, international, is that they look at it saying that what I've put into mutual funds. So from their own mindset kind of perspective, if they have got something in the fixed deposits also with the bank, they feel secure, they feel that I've done asset allocation there. So I can predominantly think about these five avenues.
Investors can keep in mind. And taking you from what you said, Manju, I mean, it's not just domestic cues, right? There is, of course, the fight between growth and inflation, which is taking place, but there are also geopolitical cues which now have to be factored in. And speaking of cues, Mayukh, according to you, what are the cues based on which one should review their asset allocations? For instance, the current ripples created in the global markets by these geopolitical events. Should investors tweak their asset allocation given these circumstances? Because we see markets swinging wildly. So any average investor would think, is it time now for me to relook at my asset allocation?
Sure. So let's talk about the cues which you talked about right now, Gautam. So the cues are such that people would tend to be worried, right? So now when you are worrying about how the geopolitical or the growth versus inflation, as you alluded to, how does it play out in our portfolios? Now, these are also times when if an investor were to get slightly hesitant about their investments, and there is nothing wrong about it, it's good to see and revisit, as I said in my first reaction, that person doesn't need to first change his goalpost. So if your goal is still farther long away into the time, probably these are times where your long term asset allocation needs a tactical input from your side. Maybe things have become cheaper, and if you want to now invest a little bit more, probably you can do that, because otherwise that's gives you a little bit closer to your goal. You are getting some things which were available cheaper, not so available 3 or 4 months back, but those are very short and very simple tools by which you can check for your asset allocation and tweak. This should not considerably change your asset allocation, because that plan was created keeping in mind 5, 10, 15 years down the lane, when you need to be at a goal with a substantial amount of money in hand, because your goals will change, life cycles won't change, and you would need that money at that point of time. So these are some of the cues. This is also important time to also check whether the graph or the trends are changing or not. So as you said, talked about growth versus inflation. If you think because of the current geopolitical issue, interest rates may go up, does that impact your portfolio considerably high? Maybe some of the assumptions need to be revisited. Is that such an event right now? Those cues are important to check whether the overall, even by taking in these geopolitical stroke other impacts, does it move you very further away, or does it put your rest of your journey under some sort of disarray? If it is, then it needs some remedial action. If not, it could be a buying opportunity. That's how I would look at it. So let's say interest rates are supposed to go up. It may not impact my asset allocation, but does it impact my other outflows? That's one of the important factor to check. If that impacts, do I need to then keep something aside from my emergency fund for my payouts? It could happen. That's also a part of your overall allocation. Again, I'm not being limited only to the gamut of mutual funds. These are a part of an individual's asset allocation where your investments may get affected. So a geopolitical issue may trigger something also more. What are the probabilities? Maybe you need to sit with an advisor, with your distributor or advisor, or if you were to do it yourself, you need to keep these things also in mind, because for the simple reasons that the goal or the age will eventually happen. You cannot become 40 at the age of 60, so you will need that money at the age of 60. So that will not change. So therefore the plan has to hit its mark. It doesn't have the choice of not hitting the mark. So that's how I would look at it at this point of time.
Well, it's all in the details when it comes to retail investors. And let's admit it, reality can sometimes be stranger than fiction, especially in the world of finance and investing. So you need to be prepared for every eventuality. And speaking of any investing topic, how can tax be far behind? So, Bhuvnesh, I'll come to you. The tax implications that one needs to watch out for when deciding asset allocation. Your thoughts?
So starting with optimizing for your taxation is always a bad idea. So tax should be an input. It should be an input when you're thinking about your asset allocation, but it shouldn't be the be all and the end all of how you go about choosing various asset classes. So broadly, you need the first thing, have an idea of what the tax implications are when it comes to equity, debt, domestic equities, international equities, gold, real estate, so on and so forth. And the second thing is, don't worry too much about retrofitting your portfolio so that you get equity taxation in as many avenues as possible. So this is typically one of the most common mistakes investors do. For example, some people might consider putting their money in an arbitrage fund because it has equity taxation versus putting in a liquid fund. Now, people typically do this without actually considering the pros and cons of putting it in arbitrage fund. If there are no arbitrage opportunities, the fund typically deploys that money in debt papers, which means, are you aware of the potential credit issues that that fund could have, or are you aware of the potential compression in yields if there are changes in the market structure which will impact your returns in an arbitrage fund versus compared to debt fund. So that is one thing. And the second thing is, in certain other categories, let's say for example multi-asset funds, there are certain multi-asset funds which deliberately go for a debt taxation so that they want to have higher allocations to let's say gold and debt. And then there are certain multi-asset funds which optimize for equity taxation, which means they have lesser gold and debt allocations. But the reality is your multi-asset allocation fund becomes an equity fund in these days, because if you have 60%, pretty much the volatility of 60% equity is equal to 100% in other categories. So that means if you worry too much about optimizing for certain taxation, if you think about your glide path, let's say for example you are investing in a multi-asset fund which is equity heavy, and let's say your goal is, let's say, 7 or 8 years. You did this to optimize for taxation, but means you're taking heavy volatility to reach that goal, and you'll have sequence risk. So the closer you are to that goal, the odds of let's say something bad happens in the market tanks, which means your fund will do horribly. And the other thing is also being aware of the nature of tax implications, in the sense that, let's say for example, if you were to invest internationally, you have two choices. One, you invest directly in stocks through LRS, or through international mutual funds. Now if you invest in direct stocks, you have a lot of additional compliance burden, because let's say for example you have to account for dividends of these international stocks, you'll have to hire a CA, you'll have to maintain additional documentation, which is it's a pain. But picking international stocks is not, it's not for everybody, which means 70-80% of investors are better off with simple ETFs and mutual funds for their international exposure. And you're getting simple debt taxation. You don't have to worry too much. You don't have to hire a CA just to ensure that you're keeping track of your dividends, so filling forms, so on and so forth. So as long as you have like a panorama view of various taxes, what is the taxation for equity, debt, so on and so forth, and then you spend some time thinking about potential trade-offs when you optimize for taxes versus thinking in terms of your goals and objectives, I think you're good. But starting with taxation is always a horrible idea. You'll end up doing things you wouldn't want to do, and you'll get terrible outcomes, which is never a good thing.
Absolutely. Focus on the goals and not just making it tax efficient. That will come as part and parcel of your calculation. Some wise words there coming in from Bhuvnesh. Picking up a thread of a conversation which we mentioned earlier about, and I'll come to Manju for this. Manju, we spoke earlier about, how during asset allocation discussions, investors, they do tend to say include or exclude physical assets like say real estate or gold. So I want to hear from you, how do you nudge investors to look at asset allocation, keeping in mind lot of their asset allocation can possibly be in physical assets?
So, first of all, when we are doing the financial plans and all, we exclude the physical real estate and gold because we need liquidity as a major component. So while we're doing financial planning, we distribute assets into three categories: fixed assets, retirement assets, and liquid assets. So real estate and gold becomes a part of their fixed asset. It's really difficult to nudge people who have huge real estate exposure to increase their allocation. It's going to be difficult to convince them that you have to get out of your real estate or you have to get out of gold. So the only way we can do the balancing is that we convince them that you need to have some liquidity in your portfolio. That's where you start building the liquidity. We can get into debt funds, equity funds, and we build that liquidity component for him. And again, real estate versus what our ancestors or our parents did, invested in this plot, that plot, that plot. So the next generation is really not interested, because that means that they have to really go out, hunt for something, invest in that, maintain the real estate, go pay those bills and all those things. So they're really not interested. They want everything click of a button. They want everything on their app. They should be able to see it, they should be able to feel it, they should be able to juggle from this asset class, that asset class, this fund, that fund. So the millennials, or even the mid aged group, maybe 35, 40, 45 years of age, I've personally seen that their real estate exposures have started slowly coming down. They look at one real estate to stay, another real estate maximum, as a part of investment, and that's about it. And then they're interested in building their portfolios. They're interested in being at ease. Maintaining a real estate is a task, but maintaining a portfolio is not a task. It's all very handy. So we don't nudge. It's the broader awareness. It's the ease of transaction and all, which has caused this gradual shift from the real estate and gold as a physical asset class to the digital asset class.
Speaking of ease, I'll get a view from everyone on this as we wrap up the conversation. Do you think taking the hybrid fund route can be beneficial for those who are not thoroughly privy to maintaining that right asset allocation mix, or those, say, who've just started their investment journey? Let me hear your thoughts on this as we wrap up the conversation. Bhuvnesh, we'll hear from you first, and then Manju, and then Mayukh.
No, absolutely, but with a caveat. I think the industry hasn't done a good job of creating better hybrid funds. Because today, if you look at most hybrid funds, what had happened in the past 4 or 5 years is none of these investors have gotten good experience, and the menu is also limited. So let's say, for example, you take your aggressive hybrid category. It's a good fund, but I mean, I would say there aren't as many good options as I personally would have liked, say for a couple of options. Now, the advantage of hybrid funds is I mean, for most of the investors, it's a one fund category. And the advantage is humans aren't built for complexity. We might think that we want it, but we honestly don't want. So the lesser the number of moving parts in your portfolio, the better it is for investors, which is where hybrid funds can play a good role. But uh, the menu is an option. Let's say, for example, for somebody who wants to start speaking about a topic, what would be a sensible asset allocation? And some of these investors might not be able to figure it out, which means probably 50-50, splitting your money equally between equity and debt is a good idea. But today, do you have a fund which does that without you having to scratch your head, figure out the historical, equity debt allocation of the fund and see if the fund manager is actually doing it? No, there isn't single fund which does that well for you. Or do you have like an all-weather kind of a fund which kind of, let's say, it does equal weighted allocations towards equity, debt, and gold? Is it a good thing to do? Let's keep that question aside. But there is a place for such funds for certain investors, but you don't have a limited menu. This goes back to that earlier question that we were talking about. It's not just investors; it's even the fund houses to a certain extent try to optimize for taxation and end up creating solutions which might not be uh, a good deal for investors. And honestly, if there were more solutions, let's say a simple 60-40 fund or a 50-50 fund for that matter, or an equal weighted all-weather fund which splits your money between equity, debt, and gold. I think these are brilliant one-fund solutions which the investor doesn't have to worry about rebalancing, so on and so forth. And the advantage is that they have inbuilt taxation advantages because the fund house, when it rebalances, the investor doesn't get hit with the tax bill. So these are solutions, but I think uh, industry as a whole can create better solutions for investors.
To your thoughts on this, the value of hybrid funds, especially when we are talking about getting that right asset allocation mix, or for someone starting their investment journey.
No, it's a good place to start. If let's say, for
Sure.
example, which is what typically I do.
All right, Manju, your thoughts on this?
So hybrid funds are good options. and but we don't suggest those at the entry level. We suggest those for people with low risk appetite, or a little fag end of their investment career, or fag end of their earning years. That's where we want the volatility factor to be low. That is one. And secondly, fill it, shut it and forget it. Those kind of investors, we know that they're not looking at active, looking at the markets every day. We don't have those kind of investors. We have passive investors. We have investors who would look at their portfolio over a period of 2 years, 3 years. Then we feel hybrid funds do a great job, because with our exposure into equities, they give a good CAGR growth. And if past performance has proved it, that with net equity being close to about 50 to 60%, they've still been able to give a 12 to 13% CAGR. So with that kind of category, we only benchmark that returns with the fixed deposit rates. As far as they get, even 30-40% higher than their fixed deposit rates, they're fine. So yeah, we like that category. We believe that category does well, but not at the entry level. Entry level is someone who needs excitement. So that's something which we give at someone who's going to just sit on it and forget about it.
All right, Mayukh, let me get in your last word on this. Any counterpoints coming from you for what, say, Bhuvnesh or Manju has said?
So, contrary, I would say that I think hybrid as a category has a lot of space. I would, in fact, start with somebody who's starting the investment journey also with a hybrid product. Why? Only for the reason is that it sets his building blocks right, and then because the person is also investing into equity and debt. What hybrid funds do actually is they ensure that you are participating in both asset classes. That's where you should first look at it as a point of view, rather than saying that this is an asset allocation and you are done and dusted. Because as an asset allocation, you are looking at many other things. This is one of the products in the asset allocation book. Was somebody to do it, what is the charm about hybrid funds is what, like Bhuvnesh talked about, that it ensures that within the product, if you were to do equity and debt, because of different tax rates, how the country is, that it would have had different capital gains impact. Were you to do it within a product, one product, your that capital gains and that rebalancing yourself is not your headache. It is being taken care of because you are giving time. There is one important factor which hybrid funds bring into place. See, everybody would like to have the equity return without its volatility, right? And that would be the best case scenario for all of us. We wouldn't need to do any education program and others. Hybrid funds reduces that edge which it brings in, and that edge is those painful days of 2008 or early 2020 or 15 or whatever, and these events, or right now which has happened, and this will continue because that's how that asset class is supposed to behave. A hybrid fund, therefore, just mitigates, or probably I would not say mitigate, it probably reduces the edges which an equity experience brings in. And many times you need to survive the volatility of equity to be able to end your asset allocation journey, reaching your goal post. And that's where hybrid fund brings in a lot of that. You need to first survive, take those risks. You would not like to take it, but you would like that return. So that is how hybrid funds fit into that space, that you are participating. You are, because you are participating both debt, equity, and if it was asset, any other asset class like gold, that your participation is there. B, your probably the structure of the fund is taking care on the long-term capital gains to some extent. That's another benefit. And C is that overall it brushes off volatility. You are not as impacted, but you are still in the you're still investing. You're still there, which is a post-inflation, post-taxation. You are in a better zone than you would have been otherwise. So do not. So I would say participation helps you. Asset allocation overall is a larger context, and among them is one of the places. is what I would say.
Absolutely. Adapt, improvise, and overcome, the mantra for any investor. But we've run out of time completely. It's time to bring this discussion to a close. I would like to thank Manju, Mayukh, and Bhuvanesh for joining us in this knowledge session. And I'm confident that our viewers have ample clarity now on finding that right asset allocation mix for their financial goals. Thank you, everyone, for joining us in this talk, and of course, for tuning in. Till next
Thank you,
time,
Gautam.
this is your host,
Thank you.
Gautam Srinivasan, signing off.
Yeah.
Hey, thanks for
Thank you.
having me, Gautam.
Thanks.
Thank you,
Thank you.
Gautam. Nice to you.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.